Europe's central bank cut its three main policy rates today for the eighth time, citing increased risk to the economy and specifically stating they didn't mean inflation. In fact, producer prices in Europe just crashed for the second straight month, just like they did in the United States. But what everybody wants to know, does this mean that the Federal Reserve will start cutting again? And what the Fed reported about pajamas holds the answer to that question. Yeah, I'm not kidding either. Not only did the Fed's latest report include that specific reference, the reason it's in there is what this whole thing is really about. Now, for the ECB, it's already back to 2% when that wasn't supposed to happen. Policy rates have been sinking worldwide outside the Fed. I mean, even Australia is joining the race to the bottom. And at a press conference today, ECB President Christine Lagarde was very clear in her reasoning for once. They are not seeing inflation pressures except at the profit margins of businesses who are having a real hard time passing on those costs to their customers, especially in the services industry, as we already saw in yesterday's video about the state of American services. Any increases in prices triggers a volume backlash, which central bankers are aiming to offset with lower policy rates, if only they actually worked. Lower rates don't solve the weakness. They are, as I keep pointing out, a reaction to it. And the more central banks lower their policy rates, the worse you know it is. And the more central banks around the world do the same thing, the more globally synchronized you know it is. The Fed is a laggard, an outlier, but it might not be for long if pajamas have anything to say about it. And what the ECB did, let's start there. In Europe, the ECB lowered its deposit rate floor, which has become their main policy rate, down to 2%. Yes, they are already back at 2%. They also lowered the other two rates, the MRO and the marginal lending rate, by 25 basis points as well. Remember where the ECB was last summer? They were at 4%. That was the deposit rate floor in June of 2024. And they started out like all these other central banks saying they intend to go slowly, at most every other meeting, maybe just a couple rate cuts a year. Now the deposit rate, which President Trump railed about yesterday, as we talked about in yesterday's video, now the deposit rate after 8 rate cuts is down to 2%, right back at historically low territory where everyone said they were never going to be. They certainly were going to be here this quickly in just a year's time. At her press conference, ECB President Christine Lagarde, as I mentioned in the outset here, was absolutely crystal clear on the ECB's thinking for once. She said, inflation is currently at around our 2% medium-term target. In the baseline of the new Eurosystem staff projections, headline inflation is set to average 2% in 2025, 1.6% in 2026. It's going to dip, and 2% in 2027. The downward revisions compared with the March projections by 0.3 of a percentage point for both 2025 and 2026 mainly reflect lower assumptions for energy prices and a stronger euro. And as we mentioned before, why are energy prices going lower? Well, number one, we had deflation in April, and therefore liquidations in March and April that pushed oil prices down. But number two, OPEC came out and said, we're going to start pumping more oil because we can't afford to wait for a recovery that we now know is no longer going to show up. With all the economic risks to the downside, oil prices are going to go lower too. Therefore, that takes a whole bunch of pressure off of at least consumer price rates. And the ECB, unlike the Fed, seems to be aware of this. But as far as real growth, Lagarde continued. Staff see real GDP growth averaging just 0.9% in 2025, and let's be honest, that's highly charitable. 1.1% in 2026 and 1.3% in 2027, and these are terrible numbers, especially after very little growth over the past couple years. The unrevised growth projection for 2025 reflects a stronger than expected first quarter combined with weaker prospects for the remainder of the year. And if you understand what she's saying, she's talking about the artificial high, the tariff front running to start the end last year and start this year, and then the payback afterward. The ECB and the Eurosystem staff right now are projecting that those two balance each other out, that there's a little bit more economic activity at the start of the year, but there'll be a little bit less of it in the middle of the year, therefore it all just evened out. When we know, especially given what we can see for the size of the payback that's coming because of the amount of front running and pulling forward of demand that took place, it's very likely that there was a little bit of a bump in the first quarter, and then second, third, and really the second half of the year, things really start to get dicey. And that's what the ECB is really worried about. In fact, they even said so, back to Lagarde. In line with staff projections, Survey data point overall to some weaker prospects in the near term. While manufacturing has strengthened, partly because trade has brought forward in anticipation of higher tariffs, the more domestically oriented services sector is slowing and is doing a lot more than slowing. So you add the downside in services along with the payback that's looming in the manufacturing sector, and it becomes a real downside risk, which is why the ECB, even though they don't want to, cut rates yet again down to 2%. One final note, that's what Lagarde actually said. They came out and said it yet once again.
Risks to economic growth remain tilted to the downside. A further escalation in global trade tensions and associated uncertainties could lower euro area growth by dampening exports and dragging down investment and consumption. A deterioration in financial market sentiment could lead to tighter financing conditions and greater risk aversion, and make firms and households less willing to invest and consume.
In other words, she's referring to what happened in April, the outright deflation, which we're seeing the consequences of that in exactly what the ECB just said. Risk aversion, tighter financial conditions, less consumption, less investment, all of the stuff that goes along with deflationary money on top of a fragile economy, and then a tariff shock beyond everything else. So as I noted in a video on Monday, European consumer prices are already and unexpectedly, quote unquote, undershooting the ECB's 2% target. The CPI came in at 1.9% year over year for the month of May. That was the flash reading there. And it's looking to be even weaker, whatever price impacts that do come from tariffs. And that's what the ECB was sort of saying. By forecasting a dip in consumer price rates in 2026, what they're saying is that they expect this undershooting to continue with the risks of even more in the near term, which puts the ECB and Europe as a whole much closer to where the Swiss are when the Swiss are already experiencing negative consumer prices already here in the month of May. But producer prices in Europe, producer prices absolutely crashed for the second straight month in April. They were down 1.7% month over month in March, and then down another 2.2% in April. And obviously that was heavily influenced by energy, the oil price crash and liquidations, especially in April. But also, oil has been moving lower for quite some time. As I mentioned, OPEC, the fundamentals of the global economy, lack of demand, all of it. Lower energy costs mean lower consumer prices and lower producer prices at the margins for energy, but other prices aren't really going up either. But the other part of the producer price index, like we've seen in the United States, is that there's not a whole lot of rising prices outside of energy, because businesses that are experiencing higher input costs are finding it difficult, if not impossible, to pass those costs along further up the supply chain and all the way up to consumers. Nobody can afford it. So everybody is eating the margin compression, which leads to further and further economic difficulties, which is why these central banks outside the Fed are cutting rates even though they don't really want to. They're cutting rates because they're forced to reckon with the downside risks that are becoming more than just downside risks. They're emerging all across the global economy. This is why we see rates behave the way they do. U.S. Treasuries had talked about those yesterday. Over in Europe, German rates to 2-year, the fundamentals in the 2-year spot on the curve in Germany, just like in U.S. Treasuries. As of this morning, the 2-year shots is down to 1.77% in yield. It had been as high as 1.9% in the middle of May. Just like in U.S. Treasuries, there was a slight increase in yields as markets re-risked and optimism after trade delays and all that stuff. But in the second half of May and the first part of June here, we've got the de-risking going on, a little bit more of risk aversion, a little bit more caution and care because of all the data that continues to confirm the downside case is actually emerging. And you'll note the 1.77% today for the 2-year German rate. That's still well below even the lower deposit rate, which is still at 2%. Even the cash market in Germany is still expecting more out of the ECB, even though the ECB would like to go carefully, meeting by meeting, data dependent, all of that stuff. The market is saying the bias is still downward for interest rates, which in many ways the ECB agrees with. They just want to see how weak before they really start cutting more aggressively again. The 10-year bond in Germany, 2.51%, down from 2.7% in the middle of May. That's the lowest since early May. But you see, rates overall in Germany have been moving lower since the early part of March, when the German government announced its major stimulus plans and sent interest rates temporarily rising. They were never going to stay up. Like we see every time a quote-unquote bazooka is announced, rates, you sell the safety and see where it goes, but where it goes is never anything good. It's never where stimulus is supposed to go, and rates over time end up going lower anyway, as they have in Germany and across the rest of Europe as well, because that's what the economy, that's what the fundamentals are actually all about. Even the German government said in late April that they expect zero economic growth in 2025, which would be the third consecutive year of basically zero in Germany for the first time ever in the modern history of the German country. They had been forecasting slim growth of 0.3%, but that's out the window. And Germany's the best example of the forgot how to grow style of recession that we've seen over the last several years since late 2022. But it's not the only one, of course. We see this pattern show up all over the world. Germany's just the best, most prime example of it. And that's what the market is pricing. Same thing as what the German government has been saying. They have zero upside potential. It's all downside risk. And the best case is more of the same forgot how to grow, which is already an enormous contraction. So, of course, you have lower growth, lower inflation, therefore lower interest rates, not just in the marketplace, but also policymakers who are being forced to see and address the same weakness that the markets have been predicting and forecasting. Everything continues to develop in the same way that markets have been predicting ever since the bond rally began, even before the bond rally began, going all the way back to Silicon Valley Bank and Credit Suisse in March of 2023. The markets have been saying in the aftermath of this is where everything's going to head. Economic downturns that don't end, and lower growth and inflation, therefore lower interest rates in the market, and eventually central banks who do the same thing, who see the same things, and lower their policy rates long after everything has actually started to settle out. But what about the Fed? So the ECB has cut by 8 straight times. What about the Fed? As President Trump pointed out yesterday after the ADP report came out for the U.S. labor market showing pretty exceptional weakness there, the ECB has cut by 8 times, a total of 2 percentage points, whereas the Fed started higher, around 5.5%, 5.25% at the lower bound, and has only done half of that in terms of rate cuts, just 100 basis points, or half of what the ECB has done. And the reason is because Powell is sticking with his inflation expectations theory, which is absolutely absurd and absolutely wrong for how inflation actually works. It doesn't work on expectations. It's not a product of the Phillips curve, but the Fed, like many economists, has no idea where inflation comes from. Therefore, they're sticking with this inflation expectations nonsense because they don't have any other choice and alternative. So even though there's absolutely no evidence for expectations affecting consumer prices, that's what the Fed is going to go with, and they're going to continue to go with it so long as the labor market isn't blaring absolutely clear and obvious weakness. So unless there's an absolutely clear and obvious deterioration in the U.S. labor market with layoffs, the Fed is going to stick to its inflation expectations theory while they watch and see whether or not that's happening in the labor market. And whether or not that's happening in the labor market, some of the most recent data, including the latest report from the Fed, suggests that it is happening and that the inflection has been taking place over the last several months. We saw, as I mentioned, the ADP report yesterday, which suggests, first of all, the artificial high last year that's dissipated, now we got the payback, but also a tremendous amount of weakness already in employment conditions. Today, we got jobless claims in the U.S., where initial claims ticked a little bit higher, were more than expected, so they're moving up, suggesting that there may be some softening there. In fact, even the mainstream media has said applications for U.S. employment benefits unexpectedly rose last week to the highest since October, adding to signs that the job market is cooling, which is what the Fed has been waiting for. Weekly claims tend to be volatile and fluctuate even more around holidays. However, recent data and surveys pointed to a slowdown in economic activity, and sustained gains in benefit filings in the coming weeks could be a sign that layoffs are indeed on the rise. That's the thing that will get the Fed out of expectations and into the same area as what the ECB and all the rest of the global central banks are doing, the race to the bottom. We've also seen challenger job cuts come in relatively high yet again, maintaining their pace for all of 2025, well above 2024. But the Fed also reported its Beige Book. Yesterday, the Beige Book for May came out. And if you remember the last time we talked about the Beige Book, there was a clear progression from the start of this year in January into April. And that progression continued on into May. What it said back in January was that in their national summary for the labor market, contacts across multiple sectors noted difficulty finding skilled workers, and reports of layoffs remained rare. So back in January, the Beige Book said, labor shortage, nothing to worry about, strong and resilient. But then in April, several districts reported that firms were taking a wait-and-see approach to employment, very different here, pausing or slowing hiring until there's more clarity on economic conditions. In addition, there were scattered reports of firms preparing for layoffs. That was April. Now we get to the end of May, the Beige Book, which came out just yesterday. It says this: all districts described lower labor demand, citing declining hours worked and overtime, hiring pauses, and staff reduction plans. Some districts reported layoffs in certain sectors, but these layoffs were not pervasive, it says. So you can see what has happened, how it has evolved from January now to May. We went from January talking about labor shortages, reports of layoffs are rare, strong and resilient, all that, to fast forward to April, we've got scattered reports of firms preparing for layoffs. And then in May, toward the end of May, some districts report layoffs in certain sectors, but at least they aren't pervasive. Went from labor shortage, no layoffs, to scattered reports of firms preparing for layoffs to, okay, they're happening, but they're not widespread. You can see how it's going from one to the other. The inflection, at least in these anecdotes from the Beige Book, which is backed up by a lot of data, is indeed moving in that direction. And if it continues to go where it seems to be going, the next Beige Book report will be, okay, there are widespread layoffs, but they're not catastrophic. Will that be enough to trigger the Federal Reserve's rate cutting? It probably will, because what's setting up here is very similar to last summer. The Fed, remember last year, around springtime, the Fed said, we're worried about inflation, consumer prices are sticky, and then the labor market data started to come in weaker and weaker, not just in anecdotes, but in actual statistics, and eventually the Fed panicked by September in a 50 basis point rate cut. I don't think they wait this long this time, not with other central banks around the world cutting as much as they have, plus with all of this data suggesting post-April and the deflation and the consequences of it, that there's already a turn in the labor market over and above the weakness that we saw last summer that convinced them to cut by 50 in September. I don't think they wait to September this year. I think there's a very good chance, not necessarily next week at the next FOMC meeting, depending on what happens in the payroll report tomorrow, but there's a very good chance they act before September because everything outside of the Fed is moving in that direction, up to including the progression toward more widespread layoffs. And even some of the individual comments from individual branches. Cleveland, some contacts who cited decreased demand reported initiating staff reduction efforts through layoffs, not replacing staff or cutting hours. So again, labor market weakness there. Atlanta, however, some contacts reported caution around hiring given economic uncertainty, and some firms developed contingency plans, including workforce reductions through layoffs, in the event conditions do not improve. And that's what everything is saying. Conditions are not improving. And finally, Minneapolis, Minnesota. Numerous employers noted increased uncertainty about future labor needs, and some were preparing contingency plans for potential layoffs. There it is again. Employers widely reported that labor availability continued to improve, which is not a good sign because that means there's more slack workers in the economy. And finally, a Wisconsin contact reported very good attendance at a recent job fair, again, not good, adding that, quote, there were fewer candidates wearing pajamas. When the labor market was perceived to be strong, you had a bunch of especially younger workers, the stereotype here, showing up at job fairs and even interviews in some cases, wearing casual attire up to including pajamas. Now that things are turning really serious, there's more workers and more competition for fewer jobs, suddenly less pajamas. And if the pajama indicator is anything to go by, it means there's a real clear deterioration in the labor market, as we've seen in the Beige Book and all this other data, which means eventually, whatever the Fed says today, like all these other central banks, how they intend to not cut, They won't have any choice. The weakness will force their hand. And that's what we're seeing all over the world. The progression in central banker rates, the progression in economic data, the markets that are being confirmed in both, all of it pointing toward lower growth, lower inflation, lower interest rates, lower everything. So with the Beige Book and its pajama indicator pointing to the same thing, it really is only a matter of time before the Fed cuts. Like I said, I don't think the Fed cuts at its next meeting, but there is a lot of last summer showing up already as we move toward this summer. Summertime being the time for basically everything that we're seeing now. It wasn't just the ADP report that was weak. Maybe more importantly, ISM services fell below 50 in a rare recession signal that we went over in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.